Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Now, this show gets you actionable insight on everything mutual fund related. And by the way, if you've got questions for us, you can send them on that number that you see flashing on your screen. Before we get to the topic that I've chosen for today, I would like to talk about some data that has emerged from the portfolios of mutual funds at the end of last month. We've actually managed to compile them. Most of them come around the time of 13th or the 14th of the month. And there's some interesting talking points that have emerged there. The aggregate cash that has been held by actively managed equity schemes has fallen for the first time in this financial year in the month of October, but that needs to be put into a little bit of context. We've discussed in the past, and I would actually want you to pull the next slide up because that talks about October and the more recent data. We've actually seen an unprecedented amount of selling by foreign institutional investors in the past month and a half to 2 months, but that's more or less been matched by domestic institutions. That's been led, of course, by mutual funds. And the feeling was that mutual funds are using the significant cash holdings that they've accumulated from retail investors to buy at these levels. The thing is, the reduction, if you look at the value, 1.49, you won't even see the difference because the decimal points are the same. The difference is about 500 crore between September and October, less in October than September. And so you will think, where is the deployment taking place? The difference is only 0.3% lower on a sequential basis. Now, you have to understand that in the month of October, there was an inflow into equity mutual fund schemes of over 40,000 crore, close to 42,000 crore rupees. So mutual funds have deployed all of that and perhaps a little bit more. But the interesting part is this: they still have a significant amount of cash, or had at the end of October, because with the assets falling, the equity market itself falling, as a percentage of assets under management, that 1.49 lakh crore now stands at close to 5%, which is still the highest level in this year. So all of this does not mean that mutual funds have not deployed. What it means is that they've actually deployed quite a significant amount. And what is also interesting, what I found interesting is, you see those NFO flows. The flows at 13,000 odd crore rupees were actually a bit of a peak in this year. They have dwindled somewhat. They've come down a little bit in the month of October. And so therefore, what you can interpret from that is that a large amount of flows into the mutual fund industry have been in the form of lump sum investments, with a lot of people trying to buy the dip. And you've had mutual funds that have tried to assist you in buying the dip. So you will likely see a lot of funds that had cash positions. We've spoken to a few of them over the last few weeks where they've started deploying, and let's see how that pans out in the month of November. It's going to be very crucial to watch that. We'll get into some more metrics on the portfolio side in just a bit, but I'd like to move now to the conversation that I've lined up for today, and that is in a fund category that you've probably been focusing on in the recent past. It is the multi-asset fund category. Particularly in the current context, it's a great idea to have a diversified approach to your investment strategy. So if you have, for example, had a large allocation towards small cap, you would likely have seen your portfolio drop more than maybe your neighbor who had an equal split between large, mid and small. But here we're actually talking about a multi-asset investment in one fund. But if you were to think of multi-asset as a category and think that all strategies are the same, it would be as problematic or as wrong as it would be if you were to think that all flexi caps are the same or all mid caps are the same. That certainly isn't the case, and that's because of the way that mutual funds have interpreted the rules set by the regulator to define their strategies. To talk about how this is constructed, I've got Manoj Jain, who is the product head of WhiteOak Capital AMC, in studio with me today. Manoj, thanks so much for taking the time. Pleasure having you in the studio. Thanks so much for coming by. Let's talk about how this is constructed, because you get into the brass tacks of it, the way that you constructed this in the making of this mutual fund. You had some thinking behind it. So first, let's define the broad tenets as defined by the regulator, and then find out how mutual funds have interpreted this differently.
Sure. So first of all, thank you so much, Alex, for inviting me. So like you know that the regulator has said that if you are launching a multi-asset allocation fund, So minimum 10% has to be invested in 3 different asset classes. So let's say usually it is 10% equity, 10% minimum 10% debt, and minimum 10% commodity. Largely it is gold, but it can be silver also or any other commodity. So this is the guideline given by regulator, which means equity can be 10 to 80%. Gold can be 10 to 80%, debt can also be 10 to 80%. Within that, you have the flexibility of buying 0 to 10% REIT in InvIT also.
Yes.
So that flexibility also with all the asset management companies to pick and choose. And you also know, Alex, that as per the current taxation laws, if a mutual fund manager investing more than 65% in equity and equity related instrument, this scheme will be qualified as a equities oriented scheme, which means after 1 year of holding period, you will get
long-term capital
gain tax.
Yeah.
But if you are allocating, let's say, more than 35% but less than 65%, then again you will get taxation benefit. You are still eligible for long-term capital gain tax, but after 2 years. So many combination can be created depending on what is your objective.
Okay, so let's talk about some of those objectives. And while we're at it, and I know that you're not going to specifically speak about your competition, but I want to pull that graphic up if we have it. I'd asked for us to pull this up because the way that, for example, an ICICI Pru multi-asset fund operates is that at the end of last month, they had equity allocation of over 70%. They didn't have gold and silver, and they actually had debt of about 13%. Let's see how that pans out for SBI multi-asset fund as well. They had 53.36% in equity, and they actually had about 37% in debt. Edelweiss had 28%, much lower and much more towards debt. In fact, that last value is how Manoj's product is also defined. So let's talk about why that is. You've got a much lower equity allocation than quite a few of your peers. What is the thinking behind that?
So see, as I said, it all depends what is your objective and what kind of investor class you are targeting. So we have a view that if somebody is investing in hybrid category and not equity, that means that person is looking for slightly lower volatility. Otherwise, you know that over the long term, equity is a fantastic asset class, should generate better return, but it is very volatile. So you are dealing with an investor who is not okay with pure equity volatility. But then why that investor is not investing in debt? Because debt is more stable, but debt can generate only very moderate return. So our understanding is that if somebody is looking for hybrid category, those investors are basically worried about too much volatility. At the same time, they want a reasonable return, and obviously they want tax efficiency. Everybody likes tax efficient return. So this is our approach. Our approach is that we are targeting a certain level of volatility, that it should be closer to gilt, okay, over the 1 year period.
Government bonds.
Government bond over the 1 year period. Within that volatility range, within that targeted volatility range, what best we can do, how we can optimize return in most tax efficient manner. So basically, we strongly believe that various asset classes have a various degree of correlation with each other. Like, you know, gold has negative correlation with most of the asset classes. Debt and equity has low correlation. Within equity, domestic equity versus US equity has positive correlation but low correlation. So we can use this correlation to achieve this objective of minimizing asset allocation. Now, if we start with this precondition that our fund should have equity taxation, which means we are saying that at all point of time, come what may, whether it is recession or boom or whatever it is, we will invest minimum 65% in equity because that is what we have promised. Then in such case, let's say you are investing 67% in equity, another 2-3% in cash to manage redemption. Minimum 10% has to be gold or commodity, minimum 10% has to be debt. So you are left with only 10% to take benefit of varying or dynamic market condition, which we believe may not be the right way, because the right way should be you first decide what should be the best asset allocation basis on various parameters and then try to optimize for taxation.
Okay, so help me understand the objective of your multi-asset fund as you've defined it. It's not maximizing capital gains, right? It is, in fact, to a larger extent, it would be protecting against capital loss or erosion while also trying to give you the benefit of investing in an equity. Is that the right way to look at it?
Yeah, let me add one more point, but you are absolutely right. So like, as we speak right now, we have about 28-29% invested in equity. obviously we have, let's say, another 8-9% in arbitrage, so that our total equity allocation, including unhedged and hedged, will be more than 35% to get the taxation benefit.
Right.
So let's say 28% equity, domestic equity plus foreign equity. Another 20% is gold. Now, both these asset classes over the long period of time should generate reasonable return. Like if I have to give you some number, over the last 13-14 years, both equity and gold has generated double-digit return, solid double-digit. So both of these asset classes are growth asset classes, and both these asset classes have negative correlation with each other. So first, by having almost 50% allocation to growth asset, you are giving some growth participation. So it is not that we are only focusing on reducing volatility. You have 50% assets which are growth asset, and another, let's say 45% assets are basically debt arbitrage, which is giving you stability and reasonable accrual income. So this combination, yes, you are right, will give you reasonable return, may not give you the highest possible return. I am of the strong opinion over the long term, equity is one of the best asset class, should give the highest possible return, but with lot of volatility, like the kind of volatility we are seeing from last 20 years.
So therefore, to drive home the point, your multi-asset fund should not be compared to an equity mutual fund. In fact, if anything, it should be looked at not as an alternative necessarily, but a lot of people have moved away from the traditional fixed income.
Correct.
And so therefore you're more tilted towards fixed income than equity.
Correct.
Okay. So, but let's talk about that fixed income component of the multi-asset fund that you operate as well. And in fact, what I've noticed is that the duration of the paper that you hold is actually on the lower end of the tenure. And so as a result of which, the potential for capital gains is not as significant as it would be if you were on the longer end of the spectrum. Why is that?
Sure. So the debt portion, how we designed our product, we want to keep duration between 1 to 5 years, which means we want to run it as a short to medium term bond fund at most point of time. To your question, why not, let's say 10 years duration? Because again, it will add to volatility. As I said, our preference of between volatility, return and taxation is that first we want to target the volatility. Because our preference is volatility first, that we want to reduce volatility, hence we will keep duration under check. Because yes, sometimes we will take right call, sometimes we will take wrong call in duration. Let's say over the time we will take more right call and less wrong call. It will add to alpha, it will add to some return, maybe 0.25% higher return, but there will be years it will add to a lot of volatility. So again, because our objective is to reduce volatility, so we will keep it short duration, 2 to 3 years most of the time, sometimes 4 to 5 years, but definitely not 10 years. Lastly, within the credit quality also, we want to target very high end of the credit quality, which means sovereign bonds, government bonds, AAA, very, very high quality AA papers only. Again, because the objective is first reduce volatility, then see how best you can optimize return, and obviously in tax efficient manner.
Okay, and one of the final points that I want to raise is how is it envisaged or how is it planned for this type of fund to react to a change in the interest rate cycle, if at all?
Yes, so it is not straightforward because again we are using the chemistry of investing, which means we are using the chemistry of these asset classes, how they react to each other. Like take example of last 3 months. In the month of July, when government decided to cut import duty, so we have seen a drawdown of about 8% in gold prices.
Yes.
And then in the month of October, as we know, that we have seen about 8 to 9% drop in various equity market indices, but gold did well. In both this period, I mean, at least till now, this product of our WhiteOak Capital Multi-Asset Location Fund did very well. In both the month, we have given very decent experience because while one asset class was not doing well, so we have to see while debt doing well, what will be the result for subsequent classes, asset classes. So usually it has been seen that in falling interest rate scenario, typically you will find equity not doing well. Because why would you cut interest rate? Because there will be some challenges, you are trying to address those challenges, and gold will be doing well. Take example of March 2020. So in March 2020, last 1 year return of equity was about minus 22%, but gold was up by 30%. Debt was also up because there was an expectation that there will be rate cuts.
Yes.
So yeah, I mean, it is not very clear that how this product will react, but I can tell you that different asset classes will react differently, and we are using those correlation to ensure that we can keep volatility under check.
Fantastic. Last question. has to do with the international equity that you hold. I saw in your presentation there's an asterisk that says that there's not going to be incrementally more investments. Is that a conscious call, and why is that being done?
Because currently RBI doesn't allow us to.
Sure.
But as and when they allow us, we can buy up to 10% foreign equity. In foreign equity, we want to buy US equity because again, Indian equity being a developed market and US equity, which is a developed market, has a low correlation, and we want to buy assets which are growth asset, but at the same time have low correlation, because that is how you can reduce risk.
Understood. Manoj, thank you so much for joining in and for giving us that perspective. I think it sets the context perfectly for the second half of this conversation, where we're going to talk about multi-asset funds and where it fits in an individual's portfolio. Thank you so much for joining.
Thank you so much, Alex.
All right. Himanshu Kohli, co-founder of Client Associates, joining in right now. Himanshu, I've chosen in the recent past to talk about multi-asset funds more than I would normally have, because I think it's an interesting space and it's growing quite significantly. Is this a conversation that you're having more with your clients? Are you telling them about it, and what is the kind of response that they have, and where, according to you, does it fit in somebody's portfolio? We were talking to Manoj from WhiteOak Capital, and he was explaining that his fund house has a slightly different interpretation than certain others, which have more of an equity orientation.
Right. So, Alex, I am a great believer of asset allocation. And what asset allocation does is it just brings in a discipline which increases the probability of success of any investor. Now, today, HNIs, UHNIs, they have the benefit of having an advisor, which is the space which we are in. But still, within our universe also, we recommend 15 to 30% into hybrid funds, and multi-asset class funds actually get positioned over there. So we recommend even to HNIs and UHNIs to look at some hybrid funds, a part of which is into asset allocation funds or into multi-asset classes funds. But for a retail investor, if you ask me, who do not have the advantage of hiring an advisor, it's one of the best things which could have happened, because they get the exposure to different asset classes. And a fund manager is basically changing between fixed income to equities to gold, depending on what's the view they have on these asset classes. And when the fund managers takes more rational decisions, there are also advantages which comes of the taxation, also the operational efficiencies which comes through this process. So I am a great believer of multi-asset class funds, especially for the retail investors, and a part of the portfolio for HNIs and a smaller portion of that towards ultra high net worth segment. It brings in huge amount of efficiency in any client's portfolios.
Now, Himanshu, what I wanted to achieve in the first half of this conversation is to kind of lay out how the treatment of these schemes can be very different. And so therefore, the return expectations also should be different. And right. So not necessarily right to compare the return of one particular scheme in the category to another. And I don't know how a normal retail investor will be able to understand. So let's try and break that down so that they understand, right? When they're approaching this investment, should it be from the objective of trying to protect their capital, as WhiteOak Capital seems to be trying to, or WhiteOak AMC seems to be trying to achieve? Or should it be from the perspective of somebody like an ICICI Pru, which has a much more aggressive equity orientation and will likely use the other asset classes tactically to move from one to the other? Do you need to identify what your objective is at the start?
Right. So it also depends on the profile of the investor. Alex, two individuals, similar age profile, can behave very differently to the same situation. Also, maybe someone's goal could be next 3 years, someone's goal could be next 10 years. Now, the difference in the time horizon and the risk appetite helps people to decide which product to go from which manager over there. So if someone is slightly more risk averse and has a shorter term time horizon, can go for WhiteOak. But someone who is comfortable taking a slight volatility in the portfolio and want to basically get into equities, but they just want some tactical allocation to happen in case the market is overvalued and is becoming slightly more volatile, so that gold or fixed income can come and give a cushion over there. They can go for ICICI Prudential over there. So I am generally believe, Alex, investors have a long-term money. They don't think it that long-term. But if they start thinking with the right time horizon, they can actually go more towards equity-oriented products over there, where gold and fixed income or arbitrage is coming to build the cushion over there, and really compound their money at a better rate over a long-term period.
Uh, Final question on this particular topic, and I have a couple more in something else that we were speaking about at the start of the show, which is how mutual funds have utilized cash. And I'm curious what you think about some aspects there. But Himanshu, where would this therefore fit in somebody's portfolio? And I know you kind of answered this, but what kind of allocation would you give to something like a multi-asset fund?
So let's say if I talk about HNI, which has a 10 crores kind of a portfolio, I would say if the profile is moderate, maybe 20% goes towards hybrid kind of schemes, which is, let's say, roughly about 2 crore rupees. Now, out of 2 crores, multi-asset class could be one third of that, which means roughly about 67 lakhs. Suppose someone is not a HNI and has only a 1 crore portfolio, and they do not have the advisor to themselves. Maybe they can have 50% towards hybrid, and out of 50%, they can have one third towards multi-asset class over there. So which could be roughly about 1 crore, 50 lakhs is hybrid, and one third of that, which is 16, 17 lakhs. So 16% of their overall asset allocation is multi-asset class. That's the way I define it. Similarly, for UHNIs, it will be a smaller percentage, but it will certainly be a part of the UHNI also.
Thanks so much for laying that out. Now, what I was curious about is I've broken down the latest portfolio holdings for mutual funds based on the data that we pulled yesterday, and it turns out that the cash holdings on an aggregate level for actively managed equity schemes has fallen by just about 500 crore, and it's fallen for the first time, Himanshu, in this current financial year. And more than 40,000 crore coming into actively managed equity schemes seems like a large chunk of that, all of that, in fact, has gotten deployed. So what is interesting to me is that you saw significant inflows across the board in the last month. There are murmurs that perhaps some people are starting to redeem small cap. Is that something that you've heard? Are people dialing you up on the phone to say, what do we do in this kind of a scenario?
Right. So first of all, Alex, if you see last month, $13 billion was sold by FPIs in India, but $12.8 billion was bought by domestic institutions. So whatever money is coming in, domestic market is actually very, very active, and whatever FIs are selling, domestic market is buying through mutual funds. And that's the reason we have seen for the first time cash allocation has come down, because markets fell between 5 to 7% last month. Similarly, this month, FPIs are selling and domestic institutions are coming and buying it. Yes, on the second part, small cap is relatively overvalued compared to large cap today. And people have made phenomenally good returns in small caps in last 5 years. And today, since it's overvalued and it has gone up quite a bit, it does make sense to maybe reallocate a part of your small cap portfolio towards large caps. Or if your fresh money is coming in, do not invest into small caps. Maybe look at investing more towards large cap, or maybe right now going through hybrid funds, maybe some of this asset allocation funds or multi-asset class funds also, because still market is overvalued, more towards the small cap, and also it's becoming quite volatile. So I would say, yes, it makes sense to rebalance your portfolio, not within different asset classes, but within an asset class also. Maybe reallocate from small cap to large cap, or fresh inflows can go towards large cap today.
Himanshu, I do want to take a couple of questions with you. We have a couple of minutes left. Devamita Banerjee, who's 23 years old, has asked a very interesting question, I think. What is the ideal fund that can capture India's long-term consumption story?
So I would say you can create a portfolio of 3 to 5 managers. 3 to 5 managers. Don't go with one particular fund. Try and build this through a systematic plan. You can also say, if I'm building up 5 funds, maybe 3 can come, one from large cap, one from multi cap, one from mid or small cap, and 2 could be from thematic. And right now, I would say technology and financial services or banking financial services could be added as a part of your satellite portfolio. Do long-term systematic investment plans in mid cap, medium term in large cap and multi cap. But in uh, financial services or technology, maybe do a short term 3 to 6 month systematic investment plan to build up these portfolios. But try and be more with diversified funds, and maybe a bit of satellite you can capture through sectoral funds like technology or financial services at this point in time.
One quick.
So I would not like to name any one particular fund.
Yeah.
It's always a combination of funds. That is what is important. And maybe you can go through the ratings of some of the schemes, or
Yeah.
you can write to us specifically, and we can send you our ratings, client associate ratings on different funds.
Yeah.
Yeah.
Okay, but one quick follow-up then. Zunera Dongre was asking, banking and pharma fund as part of a satellite portfolio. Can you suggest some names here, Himanshu?
So Nippon runs a fairly decent banking fund. You can also go through a index fund also over here, because the idea of a satellite is just to get overexposure towards that particular asset class for the time being, because they are right now satellite in nature. So I would say in a mutual fund, Nippon is fairly decent. And in a pharma space, maybe go through a index fund. That is what I would recommend.
Okay, Himanshu, thanks so much for joining in. Pleasure having you on the show.
Thank you
Insightful
so much.
conversation as always, yeah.
Thank you. Thank you so much, Alex.
All right, that brings us to the end of this particular edition of the Mutual Fund Show. Thanks so much for watching. Do stay tuned. This is NDTV Profit.